have, okay, so let's do it. All right, so if everybody can see my screen, we are talking about entity taxation and specifically entity formation. So we're going to go through this slide and we are going to talk specifically about basis and also how this impacts gains to the shareholder or the partner. So there are three types of entities that we need to be aware of. We need to understand thoroughly all the details related to C corporations, S corporations, and partnerships. Okay, but when you're seeing these questions, it's easy to just go through it, you know, whether you're using another review course or even Universal, and you're going through the C corporation section, for example, or the S corporation section, and you just went through the materials and you're getting questions correct. It's easy to sort of assume, okay, I get this. But on the exam, they're not going to tell you this is the C corporation section of the exam. This is the S corporation section or the partnership section. They're going to give you a question and you're going to need to read through it and ultimately identify right out of the gate, is this a question that has to do with C corporations, S corporations, or partnerships? So it's just super important to identify the differences in the concepts across entities. So there are four big ticket items that the entity taxation covers, and that is formation, taxation, and non-liquidating and liquidating distributions. Okay, so knowing the key differences in those four big ticket items across all three entities is the difference. Okay, so we're talking specifically about big ticket item number one, which is entity formation. And this is the initial formation of any of these three companies. Okay, so when there's this initial formation, we have a three-step process that you need to isolate in your head. So if you have notes, feel free to write this down. Otherwise, you can take a look at this deck once we're done. But we're going to break out the differences in the initial basis to the corporation or the partnership. So when I say corporation, I mean both C Corp and S Corps. We're going to talk about the initial basis to both the shareholder and the partner. And then we're going to talk about any gains that need to be recognized to either the shareholder or the partner. Okay, so when we're thinking about this initial formation, we have certain rules that need to be understood. So we're going to go through step one first, and we're going to really break out the differences in each of these three entities. Because like I said, when you're seeing a question, you want to read through the question, right? You're scanning, boom. You know that this is a question that is related to entity formation. But is this, that's not the hard part. The hard part is remembering the rules for the formation of a C Corp versus an S Corp versus a partnership. And what are they asking? If everybody can mute their computers, that'd be awesome. It looks like I'll go ahead and mute that. Looks like we're good. Okay, so like I said, we're talking about the basis to the corporation versus the partnership here. So when we're thinking about basis, this is what it is that the company is recognizing as the basis in the stuff that they received, right? The transaction here is between the company and the new shareholder or the incoming partner. Okay, so the transactions will generally include cash, could be services, but what the exam really wants you to narrow your focus on is how we treat property. Okay, so when you're thinking about a corporation or a partnership receiving property in exchange for a percentage of the company, right, AKA equity, then you need to identify, okay, how is the corporation going to recognize that piece of property that they received as their basis? Okay, and the initial basis is kind of that baseline point. So if you have a basis of $100,000, you subsequently sell that interest or that property for $250,000, you have a gain of $150,000. Okay, so that is the initial basis, the baseline, we know that. So let's start by talking about the basis to a C corporation. Okay, so a C corporation receives, let's say, property. Okay, so when you're thinking about property received, And we're thinking about how it is that we're recognizing the basis in that property received. Could be land, could be building, could be machinery. It's always going to be recognized as the greater of the net book value of the property received plus any gains recognized by the shareholder. Okay, so when you're thinking about gains recognized by the shareholder, we'll talk about this in a little bit, but there are different forms of gains. Could be boot received, could be a situation where the property we contributed had debt associated with it in excess of the net book value, but don't spin your wheels on that just yet, because we're focused on the basis in the property received to the entity. All right, so again, super important. C corporations, the greater of, right? We're highlighting that in red, the net book value of the property received plus any gains recognized, or the total debt that is assumed by the corporation. Okay, so we'll go through an example in just a little bit, but you're thinking about a situation where property was contributed by John, the shareholder, and John's obtaining, let's say, 10% interest in the company. And in exchange for that 10%, John provides, let's say, a piece of property, a piece of land with $100,000 net book value, but that property also had $150,000 in debt associated with it. Maybe it was a mortgage. So if the question asks you one of the three questions, basis to the corporation or partnership, basis to the shareholder or the partner, or the gain recognized by the shareholder, if that question is the basis to the corporation, you're thinking about the greater of the two. So in that situation, it would be the debt that was assumed because it was $150,000, which was greater than the net book value of the property. Okay, so a lot of people get confused and you're going to be so focused on trying to remember the differences in C Corps versus S Corps versus partnerships, right? And when you're thinking about this specific situation, the basis to the corporation or partnership, C corporations and S corporations will have the same rules. And this is why. Because when you initially form an S corporation, you first need to form a C corporation. And the reason is because you initially file, with your state and you form a C corporation, and then you subsequently elect S status. Okay, so you fill out all the documentation, you're saying we want to be a corporation, but we're going to elect S status. On day one, before anything else, you formed a corporation. And so the initial formation of that corporation initiated as a C Corp. That's how I remember it. That's how I teach it. And it's going to just really allow you to not get too overwhelmed with how the basis is going to get recognized to the corporation across C Corps and S Corps, because again, there's so much going on here, and it's sort of this puzzle that you're trying to just remember everything. So we're trying to break this down and simplify it. So once again, a C Corp is going to have the same rules for the basis and the property received. Okay, so cash received, basis is the greater of the two. And the reality is when you see a question on basis to the corporation or partnership, they're not going to tell you, ABC company, the S Corp, filed as an S Corp initial formation. And if they do, great. It's the same rules. But what you're going to notice across a lot of these questions is they're just going to say ABC Corporation or blah, 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 formed a corporation. They're not going to break it up into C Corp or S Corp unless we're talking about something that, has specific rules that apply, that differentiates how we're going to recognize this for C Corps versus S Corps. Where basis does become different for that S corporation is during the activity throughout the year. So if income or gains are recognized, that affects the basis to the shareholder as well as the corporation. Okay, so that's something that's a little bit different, and we're going to talk about that more so when we get into entity taxation, the fluctuation in basis. But at the end of the day, when it comes to the initial formation, no real difference. Partnerships, when we're thinking about basis, we're thinking specifically about the basis to the partner. All right, that's really where your focus needs to be. When you're thinking about the basis to the partnership, this is what we call the inside basis, which is just going to be the carryover adjusted basis. That's all you need to remember, okay? But what's really important when you think about partnerships is the basis to the partner themselves. Okay, so the focus here when it comes to the basis to the company, all right, again, we have three steps. We have the basis to the corporation or partnership, the basis to the shareholder or partner, or the gains potentially recognized by a shareholder or partner. Okay. But when you're thinking about basis to the corporation or basis to the entity, you're thinking specifically about the corporation formation, not necessarily as much the partnership formation, not as much going to get asked about that. When you're getting asked about the entity's basis during the initial formation, 9 times out of 10, the question will have to do with the basis to the company, or sorry, to the basis to the C corporation or the corporation. Okay, and your focus always needs to be on property. Okay, there's a bunch of things they could contribute: cash, property, services, but the exam, for whatever reason, really wants to narrow your focus on how we're going to treat property during that initial formation. And it's always, once again, going to be the greater of the net book value of the property contributed minus any gains recognized by the shareholder or the total debt assumed. Okay, so thinking about the basis to the shareholder or partner. Okay, so basis to the shareholder or partner is different from the basis to the corporation or partnership. We're not talking about the entity now. We're talking specifically about the shareholder or the partner. Okay, so when we're thinking about this, the focus here is really going to be on partnerships and how the incoming partner is going to recognize the initial basis received or in the property or in what is received from the partnership. Okay, so when you're thinking about entity tax and initial formation, again, what's happening here? What's the initial transaction? So the incoming shareholder or partner is contributing stuff in exchange for an economic interest in that company. Okay, so anything from cash, they could be contributing services, and they could be contributing property. But most importantly, we're going to focus on property. A side note, it is something that is commonly tested, but how it is we're going to recognize services that are contributed, always going to be at the fair market value. Okay, so we're really focused on how we're recognizing the property that's coming in. You know, you could think about cash, but cash is cash, right? The fair market value, the net book value, it's the same thing. Property is where we're focusing. All right, so basically, when you're thinking about the corporation, you're asking yourself, when you're thinking about corporations and specifically how we're recognizing basis to the shareholder, we're focused primarily on what it is we're giving up. That's how we're calculating the basis in what it is we're receiving. And what is it that we're receiving? An interest in the company. Okay, so this actually needs to be corrected. So for those of you watching, I'll make this update here. It should be plus gains minus debt. That's my bad. So C Corps, again, we're thinking about the shareholder in a C corporation, and we're thinking about shareholders in S corporations. So when you're contributing cash, the cash contributed will impact the initial basis. When you're thinking about the property that is contributed, you're thinking about the net book value in the property contributed. Okay, so again, plus any gains, minus any debt. And then services are always going to be the fair market value. Okay, so when you're thinking about S corporations, we're not going to worry about this as much during the initial formation. When you're thinking about the shareholders' basis in the company, where the shareholders' basis is really going to get impacted is during the current year activity. Okay, so impacts will increase the shareholders' basis because this is a pass-through entity. So if the company makes money, right, ordinary income, all that income is going to get passed through and taxed to the individual at their individual 1040 level. Okay, so when they're reporting their taxes, they're going to report what's called Schedule K1 on their individual tax return, and that's going to report the income that they received from the S corporation. Okay, so we're not going to worry about it too much because basis for S corps primarily going to be impacted during the current year activity, not as much during the initial formation. And when we're thinking about partnerships, this is really where I want to zero in on for all of you when you're thinking about the 3 steps to entity formation, right? The 3 steps at the highest of levels are going to be initial basis to the corporation or partnership, initial basis to the shareholder or partner, and gains to the shareholder or partner. We're on step 2, and we're thinking specifically about the basis to the shareholder or partner. And when you're thinking about the basis, right, the interest received, narrow your focus on the partner, not the partners in a partnership, not as much the corporation shareholders. So when you're seeing a question on a partnership in its initial formation, they don't ask as much about the initial basis to the partnership. They'd love to ask about the initial basis to the partner that is receiving the interest in the company. And this is where it's different. This is going to be the net book value of the property contributed minus the debt that is assumed by other partners. So again, you can look at this formula, and if you go through a bunch of questions related to partnerships in your whatever review course you all are using, very frequently are they going to just ask questions related to partnerships all within a specific module. But that's not where you're going to get these questions right or wrong on the exam. They're not going to tell you, again, this is the C corporation section. This is the partnership section. They're just going to give you a question and you need to read it. And you're going to say, okay, this is a question about partnerships during the initial formation. What is it that they're asking? A little red flag needs to go off in your head, and it needs to say, they're probably going to ask me something about the basis in the interest received. Okay, so in the partnership interest, the percentage of the company that the partner has now acquired. Okay, and you're going to think net book value of the property that we, the incoming partner, contributed minus the debt assumed by other partners. Okay, so see how this is different. See how this is different, because this is ultimately something that seems similar to how a corporation recognizes the basis in the property that they received, but it's going to be slightly different, all right? We remember when you're thinking about the basis to a C corporation, it's going to be the greater of the net book value of the property received or the total debt assumed, all right? When you're thinking about basis to a partnership, you're zeroing your focus on the basis to the partner, not the partnership, not the entity. And when you're thinking about the basis to a corporation, you're zeroing your focus on the basis to the entity, the corporation. And like we said, greater of the net book value or the total debt assumed. When we're focused on the partner, this is going to, again, be a primary focus on property. And this is going to be the net book value of the property contributed minus the debt assumed by other partners. Okay, so if you're thinking about, we'll go through an example here in just a little bit, but if you're thinking about this, isolate this. If you have a piece of paper and pen in front of you, put a big line down the middle. And I want you to say, okay, on this side, or just maybe a top, almost like a T account looking image. And right at the top, basis, initial formation basis. And on the left-hand side, write corporations, and then write focus is primarily on the entity, and then say that the property is going to be, the property contributed or the property received is going to be the greater of the net book value or the total debt assumed. On the right-hand side of that T account looking image that you just wrote down, right, that we're focused on the partner, and the basis in the property received is going to be the net book value of the property contributed minus the debt assumed by other partners. Okay, and if you all are scrambling to write all this down and you're freaking out that you missed something, feel free to just reach out after this and I will illustrate this for you. Maybe I'll go ahead and actually just illustrate this anyway and post it in the focus notes so that you can really see what it is I'm talking about during this lecture. All right, so at this point, we've talked about steps 1 and 2. We've talked about the basis to the entity, right? The corporation versus the basis in a partnership. We've talked about the basis to the incoming shareholder and the incoming partner. And now we're thinking about the step 3 that they could potentially ask when it comes to entity formation. And that is any gains that are recognized. So when you're thinking about gains during the initial formation, the shareholder or the partner has now contributed stuff in exchange for interest in the company, a percentage of the company. That's the equity they purchased. Maybe it's common stock, right? Maybe it's just a percentage of this small partnership that they've invested in. During that initial formation, a gain could potentially be recognized, right? They might have an economic benefit when making this initial contribution that is different from, just the percentage that they received. So when you're thinking about gains during the initial formation, the gain is almost always going to have to be due to, it's almost always going to be due to the gain recognized by the shareholder or the partner. Okay, so for C Corps, we're thinking about a shareholder here. Okay, so the shareholder is going to recognize a gain if two situations occur. If they have received boot, okay, so for those of you who don't know what boot is, this is anything in addition to the equity that they have received during this initial exchange. So that could be, they received 10% of the company plus 100,000 in cash. Maybe they received some additional stock or a convertible debt. Who knows? But it's something that is in addition to the equity that they are purchasing. And then in addition to that, another way that they can recognize gain is if the property contributed, right? We're always focused on property when we're talking about formation of during entity taxation. If the property contributed has debt that is associated with it in excess of the net book value, okay? So let's say John is investing in this corporation, and John, the property has a net book value of 100 grand and a a debt associated with it of 150,000. You got to read the question, and you got to see what the call of the question is asking for. If the call of the question is asking for the gain to John, you're thinking about these two scenarios, and you're thinking about the fact that if the debt is greater than the net book value, this is an economic benefit to John, right? Because now John doesn't have to pay this debt, the $150,000. Okay, so $150,000, the excess is going to be the $50,000. So that is the gain to John. All right, and finally, we have a situation where no gain will be recognized, right? There's an exception to this rule. All rules are meant to be broken, right? So no gain will be recognized if any of the following are met. If no boot is received, or if after the contribution has been made, the taxpayer now owns 80% control of the company. Okay, so this is something that is very specific. It's really important to understand. Services, just a side note, not going to be included in that 80%. But if there's controlling interest after this transaction, right now, John has purchased 85% of this company, and the question asks for the gain to John, the answer is going to be 0. Okay, it doesn't mean that he doesn't have a basis in the equity received. Okay, that's a whole other question. That's step 2. But if the question asks you for step 3, the gain to John, it's going to be 0. Okay, so for S corps, same rules apply. All right, nothing crazy here. And the reason again is because initially when we're forming a corporation, you initially file as a C corp, then elect S status. That shareholder, basically for all intents and purposes, is going through the motions first as if this was a C corp. Okay, so don't worry too much about it. And then finally, for partnerships, this is something that is likely that's not going to get asked, but services that are contributed in exchange for capital interest, right, the equity portion of the partnership, that's the only situation where gains would be recognized. But again, don't spin your wheels too much on gains related to partnerships. Whenever you're thinking about gains, we're thinking specifically about the shareholder of a corporation. Okay, so again, boot received or excess debt. If cash is received, or we have a situation where the net book value is less than the associated debt. Okay, so going through a question here, Michael formed a corporation in the current year. He contributed land to the corporation with an adjusted basis of $120,000 and a fair market value of $160,000. The land is subject to a mortgage of $40,000. What amount is the basis of the asset received by the corporation after it was contributed by Michael? Okay, so this is a good example. You're at the Prometric Center, you're reading through this question, you're navigating through it, and you say, great, we're talking about a corporation. I'm thinking entity taxation. But what specifically within entity taxation is that they're asking? What type of entity are they asking about? Okay, so we need to first identify the type of entity that the question is asking for. So it's asking about a corporation. Okay, so we immediately are thinking C Corp, S Corp, fine. But we know that this is a formation question. So more likely they're going to be asking about a C corporation. The reality is when forming a C corporation or an S corporation, you're initially forming a C corporation. So no real difference there, nothing to really, get too nervous about. Okay, so now that we've identified, great, this is a formation question, we're thinking about a corporation. Now we need to build the next step in our thought process, right? Our mental map. And that's going to be what which of the three types of which of the three questions are they asking about? Are they asking me about the formation or the basis to the entity, right? The corporation, or the partnership, in this case, the corporation. Or are they asking about the basis to the shareholder or partner, right? We need to identify that. Or is this a question that's talking about gains that are recognized by a shareholder or partner? So now we can skip down to the call of the question, and we're asking for the amount of basis in the assets received by the corporation after it was contributed by Michael. Okay, so we're thinking about step one, scenario one. We're thinking about the basis to the entity itself. Okay, so when you're thinking about basis to the entity, you're thinking specifically about property. Really easy. The other two, super easy to remember, right? Cash is cash. We don't need to worry about, how are we recognizing cash, fair value, the book value, right? Cash is cash. When you're thinking about services, little red flag just needs to go off in your head and say fair market value. All right, but it's really when they ask about property that you really need to slow it down and remember the rules. Okay, so this is asking specifically about the basis of in the asset received by the corporation. Okay, so we're focused on step one. We're thinking about the corporation. This is going to be the greater of the net book value or the debt associated with that net book value. Okay, so we remember, I'm going to scroll back up here just a little bit. It's the greater of the book value or the debt assumed when we're focused on the corporation. Okay, so when you look at the fact pattern and you're thinking about the adjusted basis, the net book value, that's $120,000, right? We can go ahead and just identify that right here. Fair market value, that's distractor information. When you're thinking about the formation, we're thinking about net book value of property. When we're thinking about distributions, we're thinking about the fair market value of the property if this is a property distribution, right? For those of you who are familiar with individual tax, you might remember that dividend distributions are taxed to the individual when received at its fair market value. So again, take a step back and think about that. We're thinking about the net book value when we're thinking about the initial formation when property is contributed. And we're thinking about the fair market value when property is distributed, when we have a dividend distribution. Okay, so we're focused on the formation. So we're thinking about the 120,000 book value. And what are we doing? Because this is a corporation, we're comparing it to the total debt assumed, and it is the greater of the two. Okay, so the mortgage is $40,000. The net book value is 120,000, right? We see the 40,000 right here. The greater of the two is 120,000, right? So that's really straightforward stuff. When you're thinking about, if this was asking about, a partnership instead, 9 out of 10 times, they'd be asking about the basis to the partner, in which case you'd have to know what percentage of the company did the partner acquire. Because if it's 50% in this case, right? Let's say this is the same situation, but they're asking about the basis to Michael, and this is a partnership. Okay, so in that case, we would take the net book value, and let's say that Michael was acquiring 50% of this company. It would be 120,000 minus the mortgage, right? But the debt that is assumed by other partners. So if this was the basis to Michael in a partnership, then we would be taking the 120,000 minus 50% of the debt that is assumed by other partners. Okay, so if Michael has 50% of this debt, he's on the hook for 50%. That means the other partners that make up 50%, the other 50%, are on the hook for the other 50%. Okay, so $20,000. So Michael's basis would be 100,000 in that case. I don't want to confuse you too much, especially if you're trying to understand, how this is all kind of transpiring. But basis is really simple stuff. If you just give yourself sort of this menu of options and you tell yourself, okay, great. We're thinking about basis during the initial formation. There's really only two entities that it could possibly be talking about when we're thinking about formation. It could either be a corporation or a partnership, right? Don't worry about the differences in C Corps versus S Corps. And then when you're thinking about basis for a corporation, just tell yourself 8 out of 10 times, are they going to be asking for the basis in the property and specific? And if they are asking for the basis of the entity, it's going to be in the property. And we need to remember the greater of the book value or the debt assumed. If they're asking about the basis in a partnership, 8 out of 10 times, they're going to be asking about the basis to the partner. All right. And that's when you remember net book value minus debt assumed by other partners. Gains, again, that's stuff that we need to just kind of think about more at a high level. Pretty simple stuff though, right? You got to remember the 80% rule. You got to remember the sneaky excess debt. If debt is greater than the book value, that's something that, a gain could possibly be triggered. So let's see. Yeah, we have one more question. We can run through it quickly. At the inception of a partnership, Walter buys 50% interest in the partnership by contributing land with an adjusted basis of $200,000 and a mortgage attached to the property in the amount of $100,000. What would be Walter's initial basis in the partnership interest acquired, right? So we're thinking about basis. Which entity are we talking about? A corporation or a partnership? We're talking about a partnership, right? We see it right here. So we got to know what percentage of the interest is being acquired. It's 50%. Booyah. Okay, so now we're thinking about what? We're narrowing our focus again on property, always, when it comes to formation. All right, so now you got to ask yourself, what is the rule? Who are we asking for? 8 out of 10 times we're asking for the partner, right? The partner's initial basis. You're likely going to see it on the exam. Okay, so you're going to take the book value minus debt assumed by other partners. So 200,000 is our book value. Doesn't say anything about the fair value, but we don't care. Minus 50% of the 100,000. So 200,000 minus 50,000 is going to give us 150,000. Why minus 50,000? Because Walter acquired 50%. So the other 50%, let's say, is owned by Sarah over here. She's on the hook for the 50% of the debt. So that's going to impact Walter's basis. 200,000 minus 50,000 gives Walter an initial basis of $150,000. All right. And that is all she wrote. We got 5 minutes left in the session. If you guys have any questions, you want to drop it here in the chat. Feel free to do so. Otherwise, we can go ahead and revert back later on this week. We're talking about doing some Q&As, live Q&As related to the homework throughout the week. We'll keep you guys posted on all that. We're going to be uploading this lecture. We're going to upload the focus notes and the questions shortly after this, so you guys can just dive right into that and attack what it is you learned while it's still fresh. For those of you who are retaking this exam, super important that you focus on entity tax. I briefly mentioned it to the few that were here before we started. Entity tax is a massive portion of your score. And if you're sitting between, a 65 to 73, you want to really make sure you can pick up some of these easy points by just learning these small tweaks to your approach, or making these small tweaks to your approach and learning these small rules, right? Simplify this, break it out from a high level to a medium-sized level of information, right? Our 3 questions they can ask. And then dig into the different rules and make sure you understand some of the key differences across the 3 entities. It's not crazy. I know it could be overwhelming, and it's going to be overwhelming if you try to attack this entity by entity. So we got our 4 big ticket items. We've got our formation, taxation, non-liquidating, and liquidating distributions. And we need to know the rules across the 3 entities for those 4 big ticket items. All right. So feel free to reach out if you have any questions. We'll go from there. And we'll keep you guys posted on some of this stuff for next week. Thanks guys for joining us. I'll just hang on for the next minute or 2 till unless if anybody has any questions they want to drop. No pressure, obviously. All right. Well, take care, guys. Have a great Sunday.